Tuition prices are dropping. Healthcare prices are dropping. Clothing prices are dropping. Technology prices are dropping, et cetera. In any debate between inflation and deflation, or any subject for that matter, the first thing I always insist on is we have to agree on our definitions. We have to agree on our terms. We don't agree on policy or outlook or forecast or anything else. But if we can't agree on the definitions, then we're kind of we're talking past each other, and it's kind of a waste of time. There is this Austrian School of Economics, and they say they count asset prices as inflation. So stock prices, Bitcoin for that matter, gold, silver, land, et cetera. And they say, look, that's inflation. The stock market's at an all-time high, et cetera. Well, that's not my definition. Now, if you count asset price inflation increases as inflation, then we're sort of talking past each other. Now, I do agree that there are bubbles. I think the stock market's a bubble. I think other bubbles are forming. I certainly think Bitcoin's a bubble. But that's not, and it's kind of, if you want to call it inflation, that's fine. But if we're going to have the debate, I'm talking about consumer prices. Now, when you talk about consumer prices, there is no inflation. It doesn't exist. And immediately someone says, well, I just filled up my car with gas and it was $3.50. It used to be $2.20. Okay, you're right. But the price of technology, the price of computers, the price of tuition, the price of a lot of things, price of clothing, et cetera, have all come down and continue to come down. So all these indices, they're baskets. It's like, well, you spend a certain amount on clothes, a certain amount on computers, iPhones, tuition, et cetera. And they look at the basket. There's no inflation in the basket. There just isn't. If you want to pick a particular thing, gasoline at the pump is a good one. Yeah, okay, I get it. I put gas in my car, but there's no inflation.
The feedback after our last talk, I think most people were referring to consumer prices. And like you rightfully said, the first thing they said, well, doesn't Jim go and pump his gas? Doesn't Jim buy milk and toast?
Yeah, I do, and I also buy clothes, and they're practically giving them away. There's selective perception. People pick one thing, and again, gas at the pump is real. I mean, like I said, I put gas in my car, and if that's all you're thinking about, but that's not an index. Tuition prices are dropping, healthcare prices are dropping, clothing prices are dropping, technology prices are dropping, et cetera. And people ignore all those things like they deserve it, like it's a gift, and focus on the one or two things that are going up. Go to the Department of Commerce in the United States and look at the Bureau of Economic Affairs and look at their PC core deflator or CPI. They're all they're either down or flat. They're not going up.
So when Jerome Powell says we will see transitory inflation, what is your response?
He's talking about base effects. What happened in the second quarter of 2020? The U.S. economy went down 31%. It was the greatest drop since, greatest quarterly drop on an annualized basis in history. And for the year, it was the greatest drop since 1946. So when you have an economy like that, and then you come into 2021, when they measure inflation, what are they actually saying? Well, they have the basket of goods and services where they're looking at a month year over year. So they're comparing, for example, April 2021 to April 2020. So a monthly data series on a year over year basis. If that's your comparison, yeah, inflation is going to go up, but that's only because the bottom fell out last year. You have to look at the base, and then you have to ask yourself, okay, I fell in a 50-foot hole. I climbed out 10 feet. I'm still at 40 feet in the hole. So yeah, so what he was saying is that in the coming months, you're going to see some upticks in some of those indices. That's true, but that's in comparison with the worst year since 1946. And so that's to be expected. My question is, where are we in the fourth quarter? Where are we in early 2022 rather, when the economy was recovering? For that matter, it recovered in the third quarter of 2020. Those base effects are going to go away. So he's talking about 3 months. The reason is not because prices are skyrocketing. It's because we're comparing it to a collapse.
Sticking to the Federal Reserve here, Jim, they recently discontinued updating their M1 and M2 weekly money supply series. This has been a series in effect since 1970.
Right.
Now, is this no news or news of significance? And does it show us perhaps a shift in attitude from the Fed here?
I think it's significant. I think it's, it's not a fraud, but it's kind of a cover up. Look, first of all, those numbers are skyrocketing. M2 in particular is off the charts. It's going up by tens of trillions.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now let's continue.
So I tend to look at base money, and I understand that base money is not the money you spend. That's what the Fed creates when they buy government securities from primary dealers. The dealers, which are banks, just give it back to the Fed. So, you're a bank and I'm the Fed, and I buy a bunch of treasury notes from you, and I send you the money out of thin air, and you take the money and give it back to me as part of your reserve position. Well, that money didn't help the economy. It went back and forth between us. So the accounting entries, I'm not saying it's irrelevant, but that's not, there's no velocity behind the money at all. Now, M1, that's the money that the banks create when they just put it in your account. Again, it comes out of thin air. That kind of money can result in inflation, but it's not. And the reason it's not is because people are saving it. And that's what people are doing. They're saving it, or they're paying down debt. But when you pay down debt, it's the same as saving. You're shrinking your balance sheet. But what you're not doing is spending it. And that's the key. You can print all the money you want. They have printed all the money they want, but it's not being loaned, it's not being lent, it's not being spent. And therefore there's no velocity, and we're not getting the economic growth. Economic growth around the world, everything is so much worse than you're hearing, because everyone equates it to the stock market. Oh, stock market's at an all-time high. Great. You said, some of my critics said I'm detached from reality. Well, I'm not, but the stock market is. The stock market is very detached from reality. But the point being, the economy is not doing that great. And so this is meant to give it a boost. It will fail. It won't work, but they're going to try. They think it's going to work. Now, there are a couple of problems with SDRs. One is, so they only go to countries. By the way, if you read this is a geek fest, but if you read the Articles of Association of the IMF, they're allowed to give SDRs to parties other than member countries. Not you and me or the audience, but they can give them to the United Nations. They can give them to the World Bank. They can give them to various multilateral organizations for anything they want. So they have not done that yet, but they have the ability to do that. But just take it to the countries. So there are, I think, 189, maybe 190 countries who are members of the IMF. They all get SDRs in proportion to their capital accounts. Well, guess who has the biggest capital account? The United States, and so forth. So the top capital accounts are really the G7 countries. China has a little slice. They're coming up, but most of the SDRs do not go to poor countries. They do not go to Africa or South Asia or parts of South America or Central America that really need it. They go to the United States, China, Canada, France, Germany, and Italy, and a few other countries. So what good does that do if those are the richer countries? Well, there is a secret desk inside the IMF that can buy and sell SDRs. So there's a secondary market in SDRs. And I'll give you an example, but it's a real one. If you're China and you have a lot of dollars and you want to dump dollars, which they do, and let's say that's one side of the trade. The other side of the trade is country in Africa. I got these SDRs. What am I going to do with them? I need dollars. You can sell your SDRs to the desk, and China will buy them for dollars, and then that way you get the dollars. So you can actually monetize them. And we know this has happened because if you look at China's reserve position over time, it's publicly available how many SDRs they receive from the IMF. We know what that number is. If you look at the SDRs on the balance sheet of the People's Bank of China, it's greater than the number that they've been allocated, which means they have been buying in the secondary market.
Jim, how does that trickle down to me, very normal person, though, if this is happening? How does that affect?
Let's separate theory and reality. So the theory is if you print money, you're going to get some growth, you're going to get some stimulus, and you're going to get some inflation. The reality is it doesn't work any more than the Fed printing, $3 trillion since the beginning of 2020. That hasn't created growth. That hasn't stimulated anything. So the point is, if the money is being spent, if the money is being, like I say, through the banking system, if it's being turned into more money with more credit and leverage, et cetera, it could possibly have a stimulative effect, but it's not actually what people are doing. They're paying bills, paying debts, or saving it. So in other words, the global velocity problem is no different than the national velocity problem. It's not there. No one has any confidence.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.